Welcome back to the channel. Today we're tackling one of the most important decisions any investor will face on the path to financial independence. How to structure your portfolio so it not only grows your wealth, but also supports you when you stop working. When building a portfolio designed to sustain you for life, two main strategies dominate the conversation. The first is to own a broad swath of the entire stock market, capturing growth wherever it occurs and selling shares when you need cash. The second is to focus on companies that pay dividends, living off the income they generate while allowing your principal to continue growing. In today's video, we'll be comparing these approaches through two popular ETFs, VTI, which gives you total market exposure, and SCHD, which focuses on dividend-paying companies with strong track records. We'll dive into how each performs over the long term, what the numbers really tell us, and how your choice could influence both your retirement timeline and your income in retirement. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Let's start by examining what VTI really offers. VTI stands for Vanguard Total Stock Market ETF, and it's designed to give you ownership in the entirety of publicly traded U.S. companies. One share, currently priced at around $325.72, represents a tiny stake in 3,532 companies, not just the household names like Apple, Microsoft, and NVIDIA, but also smaller businesses across every sector. Technology represents about 33.58% of the fund, with NVIDIA at 6.7%, Microsoft at 5.99%, and Apple at 5.88%. One of the biggest draws of VTI is its expense ratio, just 0.03%. That means for every $10,000 invested, you pay only $3 per year. Essentially, it's a low-cost way to own the whole U.S. stock market. Now, let's consider an example. Imagine Harry invests $10,000 in VTI 10 years ago. Over that period, the ETF delivered a total return of 268.49%, which means his investment grew to roughly $26,849, assuming all dividends were reinvested. That includes both capital appreciation and dividends, with an annualized return around 13.45%, even during volatile market periods. Speaking of dividends, VTI currently pays around 91 cents per share quarterly, translating to a 1.15% yield annually. On the surface, this may look low, especially compared to high-yield investment options. But here's what many investors overlook. When dividends are reinvested automatically, they buy additional shares that generate more dividends. Over time, this snowball effect compounds quietly and efficiently, without Harry needing to make any active decisions. Another important point, VTI has shown dividend growth for 4 consecutive years, and it has maintained consistent payouts for 23 years. Even though its primary goal is total market exposure rather than income generation, it has steadily rewarded investors who reinvest those dividends. This demonstrates how a broad market approach can combine growth with modest income that compounds silently in the background. Now, let's switch gears and consider an alternative approach: dividend-focused investing with SCHD. SCHD is the Schwab U.S. Dividend Equity ETF. Unlike VTI, SCHD doesn't aim to own every publicly traded company. Instead, it carefully selects 103 high-quality stocks that meet strict criteria, including a decade or more of consecutive dividend payments, strong financial health, and consistent dividend growth. The current price per share sits at $27.81, and the ETF offers a dividend yield of 3.8%, over 3 times higher than VTI's yield. That translates to quarterly payouts of 26 cents per share, deposited reliably into investors' accounts. But SCHD is more than just a high-yield option, and it has increased its dividends for 13 consecutive years with a 5-year dividend growth rate of 10.38%. This means your income grows over time, keeping pace with, or even outpacing, inflation. The top holdings in SCHD include Abavai at 4.13%, ConocoPhillips at 4.1%, and Chevron at 4.07%. The fund is diversified across sectors like energy, 20.01%, consumer defensive, 18.52%, and healthcare, 15.42%. The expense ratio is 0.06%, which still means you pay just $6 per $10,000 invested. Compared to many actively managed funds, that's extremely cost-effective for reliable, growing income. Let's revisit Harry's experiment. While his $10,000 VTI investment grew to $2,649 over 10 years, his $10,000 in SCHD grew to $21,686, based on a 10-year total return of 216.86%. At first glance, it looks like VTI is the winner for total wealth accumulation, with a $5,163 advantage. But total growth isn't the only consideration, especially for retirement planning. The real difference emerges when Harry starts living off his portfolio. SCHD's higher dividend yield and steady growth provide a clear advantage for passive income. For instance, if Harry wants $2,500 per month to cover expenses, he would need about $2.6 million invested in VTI at its 1.15% yield. That's because he would rely primarily on selling shares, triggering capital gains taxes along the way. In contrast, the same $2,500 monthly income could be generated with roughly $789,73 in SCHD, thanks to the 3.8% yield and growing dividends. Here, Harry doesn't have to sell nearly as much of his portfolio, preserving principal and benefiting from favorable tax treatment on qualified dividends. Over a 30-year retirement, the tax savings could accumulate into hundreds of thousands of dollars that remain in his pocket rather than going to the IRS. To visualize this, imagine two scenarios with a $500,000 portfolio. With VTI at 1.15%, Harry earns $550 annually in dividends, or just $479 per month. To generate a livable $40,000 per year, he must sell around $250 worth of shares each year. On that gain, he would owe about $2,055 in taxes, assuming a 15% long-term capital gains rate. With SCHD at 3.8%, the $500,000 generates $19,000 annually in dividends, $1,083 per month before any share sales. The remaining $21,000 needed to hit $40,000 annual income can come from selling shares. But now taxes are lower because most income comes from qualified dividends. Over time, this approach leaves significantly more money in Harry's hands. So, which ETF should you hold forever? The answer depends on your timeline and goals. Choose VTI if you're younger, focused on maximum wealth accumulation, and won't touch your portfolio for decades. You get exposure to thousands of companies, including high-growth sectors, and benefit from long-term compounding. On the other hand, choose SCHD if you're closer to retirement and want a growing, reliable income stream. You receive higher dividends, favorable tax treatment, and inflation protection through consistent dividend increases. SCHD prioritizes cash flow over maximum total returns. But here's where savvy investors often find a middle path. Harry, after experimenting with both, eventually adopted a blended strategy, holding both VTI and SCHD in a strategic allocation. For example, a 70-30 split, 70% VTI for growth, 30% SCHD for income, can shift over time. Start with 90-10 in your 30s, move to 60-40 in your 50s, and 40-60 in your 60s. This approach provides the benefits of both worlds: long-term compounding from VTI, cash flow from SCHD, and a diversified portfolio of over 3,600 holdings. You capture growth in technology and other high-performing sectors, while securing stable income from energy, healthcare, and consumer defensive stocks. This dual approach also smooths out volatility. When markets dip, your income-producing portion continues paying dividends, reducing the pressure to sell growth assets at a loss. Rising dividend income helps cover expenses, while the growth portion continues to compound for long-term wealth accumulation. Both funds' low expense ratios, 0.03% and 0.06%, ensure most of your returns stay invested. In essence, investing doesn't have to be all or nothing. Total market ETFs and dividend growth ETFs each have unique advantages, and combining them strategically allows you to maximize wealth, secure income, and manage taxes efficiently. By understanding the mechanics behind these funds, you can make informed decisions that align with your retirement goals and lifestyle needs. So here's the takeaway. VTI is your engine for long-term growth, SCHD is your cash flow machine, and combining them strategically lets you enjoy both. Start early, reinvest dividends, and adjust your allocations as your retirement horizon approaches. With this approach, you don't have to choose between growth and income. You can have both, with lower risk and greater flexibility. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.